Welcome, everyone. Andy Tanner here. I'm joined by Corey Halliday on this fine day. God, we've got lots
I
and
get
lots of
called
people.
I get called Corey Holiday all the time, so I
Holiday?
answer to both. Holiday.
Well, I know Halliday when I see one because
That's right.
Doc Holliday was my cousin. Doc
Oh
Holliday,
yeah,
yeah,
we've talked about that.
a baseball player.
Roy.
Yep,
Yep. The great.
yep.
Yep.
So he was a special player. All right. So let's start with this. Raise your hands. You guys are figuring this out, I'm sure, by now. Raise your hands if you can hear us. That way fantastic. I've given many a webinar where I was talking to myself, so thank you, everyone. I'll put your hands down. And we just hope you're enjoying the program. We just hope that you're engaged and that you maintain your enthusiasm and that you're paper trading and that you're those of you that are involved in the coaching program are enjoying that. And wherever you are in the world, we hope you're doing well and that you're healthy and that things are going awesome. I was speaking with Corey, I don't remember what it was, a couple days ago, and for whatever reason, I don't know if it's just because of the circumstances that the world is in right now, but we have just enjoyed this particular group. The attitude of these students, Corey, are just blowing my mind. I think it's just, in the middle of everything we're having to go through, having something to work on and improve and have a bright spot is just an exciting thing. So we just thank you guys for your, look at this from Paris. Amazing. It was funny. You guys, I was working hard in West Virginia. We remember when I had a couple of weeks ago, I had everyone shout out where they were from. We had just pages and pages of everywhere in the country. I took a screen capture of that and I sent it to the big man behind the curtain that makes all this happen, Mike Dennison, and it was amazing. I mean, Daniel Dio, I was reading about Venezuela. Talk about a country that's been through it. Venezuela, they just had it tough. They're sitting on the most oil of anywhere in the world, and yet their currency is exploding. And Daniel, I'll tell you, if there's anyone on this that knows about how fragile a currency can be, with all the money United States is printing, we should look to Venezuela and try to learn from what you guys really know, to tell you the truth. So,
Yeah.
Daniel, it's good to have you.
Some of the negative side effects of hyperinflation and all those sorts of things, for sure.
We got Jose Medina, also from Venezuela. Wow, that is really cool. I'm going to ask Daniel a question. Daniel, what happens to your debt in hyperinflation? I'm just getting curious, get the boots on the ground here. What happens to your debt in hyperinflation for Daniel? It's kind of an interesting question. Look at this. Yomar's from Venezuela. Wow. I'm waiting. There's so many people answering that Daniel can't get a word in edgewise. It gets wiped out. It's kind of an interesting thing. Debt, savers lose. Obviously, if you're saving money and your money loses value, the savers lose. But if you have debt and it goes down, it was crazy. Daniel says, I went into his debt as fast as I could, and then I bought a different currency. So it's an interesting thing. The reason I bring that up is in your 4 pillars, let's just talk about that as an introduction. In your 4 pillars, if you haven't gotten there, this is a really great financial education concept for everyone to know. I'm not going to go into detail on it because we don't have the time. But just to start with, here's an interesting idea. Asset minus liability is net worth, isn't that right? And we want our net worth to go up. So think about this. If the value of this column goes up, everyone can type this in. If the value of this column goes up, what happens to my net worth? Let's let everyone type it in. Yep, it goes up. So it goes up. Now watch this. If the value of this column goes down, what happens to my net worth? It also goes up, right? Because if this goes down, this goes up. So that right there is a lesson that every 4th grade student should learn, is that if you'd like to increase your net worth, there's 2 ways to do it. You put things in your asset column that increase in value, like gold or stocks or real estate. And you put things in your liability column that go down in value, like Venezuelan currency. And actually, believe it or not, this is going to be hard for people to swallow, but the US dollar loses value every single year we have inflation. We have an inflation target of about 2%. So if you buy real estate, you're actually putting a home in the asset column and you're putting the US dollar in the liability column, and as long as it cash flows and you can service the debt, you're about to get very, very rich. So that's a really interesting way to look at it, that if you see, a lot of people want to save dollars. Well, think about this. What is happening to the value of a US dollar? It's going down. And if this goes down, your net worth goes down because your buying power goes down. And so it's an interesting way to look at that, something every fourth grade student should learn in school. And it completely baffles me that that this is not taught in our schools. I have no idea right there. Yeah, Christopher Pearson Smith has an interesting idea. Well, yeah, I would use debt 100%. He says, what if you bought your real estate using Venezuelan dollars? That can go in the opposite direction. As a matter of fact, be careful with that, because and then we'll get on our topic. But Corey, I was watching Poland, and Poland has, I think it's called the zloty, is their currency. And what they were doing, though, is they had their home here, but what they did is they didn't use the zloty. They used the Swiss franc. So they were over here using the Swiss franc. And remember what happened to the Swiss franc when they unhinged it from the dollar?
When they removed that link to was it the euro? I think it was tied
euro.
to, right?
Yeah, it was tied to the euro, and they removed that link. Well, now it took 20% more zlotys to buy one Swiss franc, which means basically these guys' mortgages went up by 20% overnight. Yeah. Overnight. Mm-hmm. So imagine having a $1 million home, and you wake up in the morning and now it's $1.2 million in debt. You just or imagine having a $5,000 a month mortgage, and now it's $6,000. Like that quick. So you want to really learn currencies. That's part of your financial education. Very, very important stuff. Okay, but this is about cash flow. Oh, go ahead.
And I was just going to say, using that as a comparison in Venezuela. So if you're shorting the currency that's going down in value, one way to short that currency is, like you said, to take on debt in that currency, right? So in Venezuela, if you were buying assets and taking on your debt in, what is it, the petro?
No,
what is their currency?
It's the bolivar, I think. Venezuelan
bolivar.
Okay. I believe, is what it is.
There you go. So the bolivar, if you're shorting that currency, then you're basically in a situation where you've got that positive of two effects, because as the purchasing power goes down, and think about this in US dollar terms or wherever you're at, if the currency value is dropping, the amount of currency it takes to buy goods and services, now it requires more of them, right? So it used to take you $100, now it takes you $150 to buy the same amount of goods. Now it takes $200 to buy the same amount of goods. So in other words, the goods are in essence going up in value. Whether they're going up or not, if the currency's going down, their value appears to be going up because it takes more of your base currency to buy them. So it could be that the assets are going up in value. It could be that the currency is losing value, but either way, that dynamic is working for you. And that's a big talking point right now when you're talking about the U.S. adding trillions of dollars of debt to the balance sheet. That is dilutive. That dilutes the existing currency and in essence drives up asset prices. Whether it's because the currency's dropping or the assets are rising doesn't really matter. Either way, the effect is the same.
One thing to think about along these lines, maybe I can find something closer, is, let's say I take a gold round, like a gold coin. It's a gold round. These are pretty thick, I guess. And they're all 1 ounce. They're all fungible. They're all the same. And if I go back in the time of Rome, and I go into the market and I bring in a 1 ounce coin, I can get a nice set of leather sandals, right? However they wrap around. I can get nice leather sandals. I can get a very nice toga, right? I can get a nice little toga here, right? Nice toga. And I can get a little, maybe a leather belt, like a leather sash around it, something like that. And that's what I can trade for 1 ounce of gold. Now you bury that ground in the sand for 1,000 years. And what's interesting is if I take that gold today, that same ounce of gold today, and I go down to Fifth Avenue, I can get myself some leather shoes, right? I don't know how to draw shoes. I can get me a nice suit right here, right? I can get me a nice suit of clothes, maybe pinstriped, and I can get a high quality fashion leather belt for that. $1,700 suit right around in there. And if you take that and bury it in the sand for 1,000 years, and we wake up in the morning, I can get myself some space boots, right? I can get myself an anti-global warming. I can get an anti-global warming special T-shirt with reflective UV protection and a leather belt. And it's going to cost about the same thing. In other words, 2 eggs and 2 strips of bacon are going to get swapped forever, regardless. And this is without money. So even though you think gold is increasing in value over time, gold is not increased in value over time. It buys the same stuff. It's just retained its value over time. Gold buys the same stuff today that it bought when it was $35 an ounce back in the Roosevelt time, where they confiscated all the gold. So that's an interesting lesson on value. Okay, so let's talk about this. You guys seem to like, I've never done this in the Quick Start Labs before, but remember last time where we did the delta hedging, we used the Ultimate Options template. Did you guys dig that? Was that cool? Yeah. Okay, so we'll do that again. We've got there in the Ultimate Options series, there's 50 different classes. So we gave you one of them last time. We thought we'd give you another one this time because it fits. And hey, it's Quick Start, so let's Quick Start. We have 3 covered ways you can do a covered call. We're going to show you the most basic one today. But Corey and I, we've taught this together many, many times. And one of the most important cash flow basics, staple, important cash flow trades is the covered call. And there's 3 different ways you can do it. We're going to do it the most they're all conservative, but we're going to do a covered call today. We're going to draw risk graphs today. We're going to do all kinds of cool stuff today. Philip says, hey, how do you cash flow gold? Well, I'll tell you how you cash flow gold from last time. I guess we ought to quickly, I'm glad he brought that up. We should check in on all of our trades that we made, shouldn't we? So here we are. This is going to expire on Friday, and we're looking pretty good on it. We're still 91% chance of being in here. Our standard deviation is still within our limits. So that's one way to cash flow gold right there, is with that iron condor. And then what's interesting about that, we started with the low side on GLD. So notice that one is way, highly likely to succeed. Basically, if you just left the put side, which is what we started with, the market has moved higher. So that put side is, almost, you can never say 100% 2 cents
guaranteed.
Time decay left.
Yeah, it's basically going to be at max profit.
Yep.
However, because we've shifted higher, now it just really, we finished the iron condor, so we sold the 170, bought the 175. Well, the market's still at 163, so are we likely to be above 170 when it's trading at 163 right now? No. There's still, there's only a 10% chance roughly of that happening, or 8 or 9% chance. 8%. So yeah, 8% chance we could get up there. That and you can kind of look at it from the standpoint of, that's why we like that style of credit spread where you have this high probability. But sometimes even what started off as highly probable, the probability will shift, and you need to be willing to shift with it if things change. If in the next couple of days gold were to really have a big blasting move higher, we would need to be hedging this trade going into expiration over the next couple of days. So even though we're 90% probable today, that might turn into 70% probable tomorrow if gold were to have a big blast higher, and we'd have to, manage the position as needed. So good stuff.
Little technical analysis for you guys. How confident do I feel that, is it going to stay? It looks like it's raging, but if you look at this real carefully, you'll notice big candle, medium candle. This is called a spinning top candle. Do you see how this is waning a little bit? This just did the opposite. This one was taking off big. This one is waning a little bit smaller. So, it could always go higher with the money that we're printing. Many people, including myself, have purchased a lot of gold in the last 2 months or last month. So I bought more gold, knowing the Fed was going to print all this money. And so we do have some technical analysis that it also shows a cup and handle breakout pattern. So we do have to keep an eye on this. But if you look at this, there's a little cup and handle. Look at this. There's a cup and there's a handle showing a resistance mark. And on this candle right here, it blows through it. I would expect this to probably come back and retest and maybe keep this trend line going right here, where this trend line gets here. Give me another chance to maybe buy some gold.
Kiss goodbye.
Kiss hello there, yeah, all that stuff. So a little bit of technical analysis. You guys, more important than understanding cup and handles right now and trend lines, are you guys starting, you've been in about 3 or 4 weeks now. You've had classes with me, 4 Pillars, Corey. Are you guys starting to see how the 4 pillars work together? Fundamentals. Let's pick apart the gold trade and do all 4 pillars quick. First, we talked about fundamentals, where we talked about inflation, and we talked about a dollar losing value because we were printing it. That would be which of the 4 pillars? Fundamentals, right? It gives us a reason to think about gold. It gives us a reason to talk about gold. We're talking about Venezuelan dollars. We're talking about printing money. We're talking about sovereign fundamental analysis, not corporate. This is not a corporation. This is a gold future. So we're on the sovereign level of fundamental analysis. Okay, the technical analysis is right here. We got cup and handles. We got an uptrend. We got a breakout. We have candles that are waning. That's called a rising wedge. And as you continue to go to Mentor Club, as you continue to hang out with Corey and I, you'll learn more and more and more of cup and handle, trend, resistance, support, and it just becomes very, very fluid for you. You're probably already, if you look back about what you knew about money, fundamentals, and technicals maybe 2 months ago, you might say, I am orders of magnitude further along 5 weeks now hence than I was 5-6 weeks ago. Well, guess what? Think about where you're going to be a year from now. All of you have Mentor Club for a year. It's going to be incredible. And you can go back through your 4 pillars as many times as you want. And so it's going to be incredible for you. Then we looked at the cash flow, which was here on, let's get the cursor back. Then we looked at the cash flow on our GLD position. If I can bring that up. And we said we're going to do first we said we were going to do a bear call spread on it. A bull put spread on it right here. And then we thought, we probably have enough room to cash in and do this, and this is going to work out. We're still within a standard deviation here. We're not in a nasty place where we're losing money. We're making money still. We've had a lot of time decay. And if that pulls back a little bit, we're going to be in good shape. And even if it extends a little bit, I don't see this getting to 170. I think we're going to be fine, and we're not going to have to, when do I start delta hedging? When I get into this theta switch or above the strike. So we're not above the strike. We're not above this theta switch. We're profit zone all the way. and we've made money on all of our trades, which is bad because you guys need to know that, but what were the chances? Well, the chances were 90% that we were going to make money on all our trades. We were hoping maybe one can get away from us, but it'll happen. It'll happen in your paper account. You'll deal with it, and you'll practice with that delta hedging, and you're going to be just fine. So, and our risk management would be the delta hedge here, probably, is where we would go. So another thing we could do if we wanted to, is we could do something rolling up. This one right here has got all the profit in it that we want. So if we wanted to, we could buy this one back, and then we could move it up here, couldn't we, Corey? And we could make our condor more narrow and squeeze a couple more bucks out of this if we wanted. So you'll learn about those. Right. You'll watch Noah Davidson and the Mentor Club do stuff like that, because really, we got 2 cents here on this side. We're looking at 2 cents here, or 3 cents, 37.97. We collected 38 up front. If we want to leave the trade and not have to keep our promises, we can do that for 3 cents. So it's basically, that trade's done. And then we could sell more. Maybe we sell the 150s and 155s, and we could do that to squeeze. And
that might have been a really good adjustment to make at the same time that we had added the call side. Like we could have rolled up the put side because things were kind of pushing that way.
Bullish
anyway.
And
not only would we have collected the call side like we did, but we would have brought in more income on the put side, because we're basically saying we're shifting it to where it's more probable that that we could be in trouble, so they're going to pay us more money for that. In other words, instead of insuring the stock from 136 on down, we could have shifted that up to where we're insuring it from 150 on down or something like that.
Just remember, I know it gets complex for everyone, but just remember, we sold the 136s for 82 cents and we sold the 131s for 44, bringing a total of 38 cents. So all I'm saying is we could have done this again at 151 and 155 maybe, something like that, or 150 and 155 maybe, something like that, and just collected a whole new set of premiums, since this one has gone our way. So great trades.
By leaving a trade, we mean exiting. So you can always, at any point we could exit these trades. We could do it right now, in fact, for a nice big profit. So even if we wanted to say, let's just close this whole thing up, we can see what this entire trade is quoted at to buy it back. Remember, in this trade, we collected our money up front. So if we can buy it back and close everything down for less, the difference is our profit. Think about, we have a cost basis when we entered of how much we collected, and now we're getting quoted every day, how much would it cost us to close this out? And right now, we could look at a quote here. Go ahead and, that'd be great.
It'd be
show
37,
them the price differences.
Yeah, it'd be 37, or about 38 bucks.
About 38 bucks.
So 38 bucks. So look at this. If you, if we have tied up in here, what is it, 438. So if we go $38 divided by $438, I think that's what it was, wasn't it? Did I get that wrong? Yeah, 438. So we're making 8.6% if we leave today. If we get out today, we make 8.6%, but we're greedier than that, so we're going to stay in and keep that money. Okay, let's talk about covered calls now. Now, this is a very important quick start lesson. The covered call is one of the best, most common. It's just, it's hard to say, oh, this is just a great trade without saying I recommend something. But this really is a staple for many, many people, and we'll just go through it. Of course, we never do one without our disclaimer of, saying, look, this is education only. We use specific transactions, like we use GLD for an iron condor. That's for educational purposes, not recommendation. You can see how that line's very important, because when you see trades with this type of probability and this type of return, it's very tempting to say, oh, I'm ready on my first time. I'm going to go do this for real on my first time. No, that's like flying an airplane without a simulator first. You always go simulator before you go solo. And then this stuff has risk. It just does. And that's the important part. So we're going to draw some risk graphs. And you'll start to, like last week, we got a lot of fan mail from drawing the risk graph out. In other words, not using the software to do the risk graph, but actually learning how to draw them. We had some fan mail from people that said the light bulb went on. I actually understood the risk graph much better when I had to learn to draw it. And yeah, it's kind of a pain in the neck to learn to draw it, but once you do it, you can do it in your head just as fast as this thing can happen on the computer. Believe it or not, you really can. So covered call means we're going to own a stock and sell a call to generate income. So let me set it up this way, okay? And we're going to create what I call and other people call, I don't know that it's the best word for it, but some people call this the Wheel of Fortune. And of course, I've just really messed up my computer here, Corey. Unbelievable.
Freeze up on you.
Yeah, there we go. I think I got it. Okay, so watch this. We start off, you guys, most of you started off with me with probably my favorite trade. My favorite trade personally, and you might find a different favorite trade, but I love this trade right here where I have some cash, right? And, maybe I've got, let's just say $10,000 or something like this. And what I do is I make a promise. Watch this, to buy low, to buy stock at a low price, And so I see a chart. I'm greedy when people are fearful. I'm doing Warren Buffett, right? We started off with this. This is called the cash covered put, where I make a promise by selling a put, and that premium comes in. So maybe on this $10,000, maybe I make $200, something like that. I make $200 in cash flow. And if the stock goes up, I keep the $200. If the stock goes sideways, I keep the $200. And if the stock goes down, I keep the $200 plus I buy the shares. Okay. Does everyone remember that trade? The first one we ever did, the first one I probably ever showed you, where I sell the put. You guys I'm getting yeses on this. This is good. So, yep, you guys got this. Beja says, yes, and it's amazing. It is amazing. I love this trade, right? And so, yeah, I'm selling a put, and I really don't care whether it goes up, down, or sideways, because here's the thing. If it goes low, I'm happy to buy it so cheap. I mean, I'm excited to keep my promise. So that is a key. Think about it. The difference between this and insurance and being an insurance salesman is the insurance companies don't really want to keep their promises. They really don't want to. When someone calls in with a claim of fire or theft or car accident or life insurance claim, the insurance company rolls their eyes and they got to fork out the cash to pay it. Here, it's different because when the insurance company pays for a fire, the insurance company doesn't buy the house, do they? They fix up the house, but they don't buy the house. Well, here it's different because every time we keep the promise, we acquire the asset that we wanted in the first place. So the biggest difference between collecting premium here as an insurance company is we actually want to keep our promises. We actually would like the scenario of buying the asset. I'd rather have the asset than cash. So, let's draw a line here, and there goes a month, let's say a month. Now, here's another month, and one of two things can happen, scenario A or scenario B. So the next month, what it might look like is I might have $10,200 in cash to do this again, correct, in my asset column. If the stock goes up or the stock goes sideways, that income goes in my asset column, right? I take that $200 and I add it to my tally, right? That's one scenario. The other scenario is if it goes down. And if it goes down, my financial statement looks like this. Income, we ought to label it. Okay, income, expenses, asset, liabilities. The other thing that might happen is I might now have, let's say this stock was, $100 a share. Now I might not have 100 shares of stock. So either of those are fine with me. I'm happy adding to my cash at 2% in a month, or I'm happy adding to my stockpile of stocks. So either way, I'm happy. Does everybody catch that? So if it's A, what am I going to do? I'm going to rinse and repeat, right? I'm going to make another promise, bring in another $200, and I'm going to sell another put. And I'm going to try to get maybe a different stock that's cheap, or maybe even the same stock if it went sideways and I want to do it again, right? I'll sell another put. I rinse and repeat, and I try to get another $200 in here, and I just start growing that at a ridiculous rate. But what if it's B? What if it's B? Well, watch this. Let's look at where this could go. It could go down, which I'm okay with because I'm no longer caring about the price. I'm a Warren Buffett guy. It could go sideways or it could go up. What if they give me an offer I can't refuse? What if they give me an offer I can't refuse? What if I say, look, I really want just the dividend on this. I don't want to turn into a stock trader. But if someone came to even Warren Buffett and said, you know what, I'll give you double what you paid for your Coke, he'd probably sell, right? That'd just be so much profit that he could take that money and buy even more assets somewhere else, right? So I don't really worry about things going down because I'm going to get my dividend and I'm going to hang on to my shares long term. If it goes sideways, great. But what if I get an offer I can't refuse? So watch this. I'm going to make a promise. I'm going to make a promise to sell at a great price. So here I made a promise to buy at a low price. Now that I own it, hey, you know what? Pay me $200 for a promise to sell at a great price, right? And it's not going to be much money. It might not even be 2%. It might be 1%. It might be 0.5%. Might be. But that'd be kind of an interesting idea, wouldn't it? Wouldn't it? So
hey, Andy, in your asset column, add that 200 as well. We're getting that question.
Oh, yeah.
But you have the 100 shares of stock and you have the 200. So we Correct. Can say 100 shares plus they don't get the That's $200 true. Back, so we can add that in that asset column. Yeah. Perfect.
Plus that 200. That's true. Thank you, whoever brought that up. So now if it's scenario A, I just go back to this and I just make another promise to buy stock low. B, if I want to buy in the stock, I say, great. I'm happy with the dividend I'm going to get on this. I'm happy, I'm in the Coke business. I'm selling drinks now. I'm selling drinks. But if the price shot up huge and someone gave me an offer I couldn't refuse, that if the price goes extraordinarily crazy, like beyond a standard deviation, maybe I do sell. Maybe I say, you know what, I'll sell because I can always go out and buy more stock. And you guys already get the idea here. It's not always perfect, but two things can happen. If it's this scenario, then it's this graph again. If it's this scenario, then what's going to happen? I'm either A, going to be back in cash, or B, I'm going to be still in stock plus my $200, right? And so either way, I'm going to keep on using time decay is the idea. And so one of the things you're going to notice, and hopefully that wasn't too unclear.
Yeah, and let me just add one thing. So notice we made two different promises there. The first one, we sold a put, which is a promise to buy. The second one, we sold a call, which is a promise to sell. So once we obtain the stock, we can turn around and do what's called the covered call strategy, which he's showing. So we sold the put, we get to keep that premium no matter what.
Yep.
We sell the call, we bring in an additional premium. So we're stacking those premiums on top of each other. And sometimes we get the stock, sometimes we don't, but we're stacking those premiums up regardless.
So what we're really working on is building up our theta number. If you look at the stocks we own, like ZTO, we have a delta of 100, but we have no theta and we have no vega because there's no option, there's no time component. But almost in every other trade we have here, we have a delta and theta, or we have a theta component. and sometimes it's positive. If we've bought an option, it's negative. If we own an option, it's positive. So we like positive delta. So with that, let's take a look at this. So once I own the stock, covered call means I own a stock and I'm selling a call. I'm basically getting paid to sell what I have, and out of the money means it's going to have to go up. They're going to have to give me a good profit on this for me to agree to sell it. So basically, selling a put means I'm getting paid to buy things low. Selling an out of the money call means I'm getting paid to sell things high. Think about that. People want to buy low and sell high anyway. Why not get paid to do what you want to do, buy low, and why not get paid to do what you want to do, sell high? And that blows people's minds, because they're like, whoa. I could have gotten paid. Like, I've had people say, I had one guy say, why would you ever just go buy a stock? Well, if you really wanted the stock, go buy it. But if you don't care that much and you really like it at a lower price, well, sell a put, right? Sell a put. So very, very cool. So on this particular trade, we're actually, and in both of those trades, selling a put means I actually do want to buy stock. And selling a call here means I actually do want to sell stock. So in both of these cases, we like doing this with the idea that we're okay with keeping our promise. That if the stock goes up and it does hit a price that's kind of crazy that we didn't think would happen, well, by golly, we're happy to sell. If you want to give me that price for it and pay me up front, if it winds up going up, I'll tip my hat to you. We're taking a bird in the hand and giving up two in the bush. Let me say that again. We're taking a bird in the hand and giving up two in the bush. And what's going to happen when we do these, what we call out of the money, meaning away from, higher than the price is right now of the stock, it means that we're going to generate a little less income than we would at the money or in the money. But you know what? It allows for more upside in our stock sale if it even gets there. So, this limits the risk of holding stock simply because you're getting paid more money than if you just held stock by itself. Obviously, if you add more money to that equation, you lower your risk. Number two, you get an income from something you bought a long time ago. Now, you guys will remember that Corey and I did that Kraft Heinz trade, right? Over and over and over and over again. Well, part of what we're doing right now on Kraft Heinz, in fact, we're looking at it Monday, is, Corey, you and I are selling calls on that are way high all the time, right? Oh, he's muted.
That's exactly right. So, yeah, that's exactly right. The covered call income is basically us saying, well, we might be willing to sell if it goes way up here. And usually we're not even willing to sell when it goes up there. What we end up doing is buy our way out of the promise and then sell another piece of income and another, because we're really interested in retaining our shares. But what we can end up doing is kind of managing the trade similar to what we've already shown with those credit spreads, where we say we're probable to just bring in the income. But if it really starts to push those limits to where we might have to turn our stock over, we can hedge that and then not have to give up our shares and then turn around and start selling more income. So we get in that same, you'll notice this same exercise over and over again with trading strategies, which is we're looking to, as Andy said, get that theta working in our favor, bring in income as option sellers. There's a reason that Geico sells insurance and makes a ton of money. What they do is they sell risk, basically, but by stacking up all these premiums, even though they lose here and there, they've stacked up so many premiums that the net effect is a lot of profit, right? And we look at trading much the same way, where we're going to have some situations that, we take a loss in this or we take a loss in that. Geico doesn't quit because some of the cars crash. They say, hey, that's built into my expectations. I'm bringing in all these premiums, and I know as long as I do that, I'm pretty much in a winning situation because the probability of loss is very low. And even when they happen, I have all these premiums to backstop that and then some.
There's the insurance business in a nutshell, right? They bring in premiums. Some of it they have to use to pay the claims, and whatever's left over is profit. They have no manufacturing costs. They have no shipping costs. They have no raw materials. All they have is promises they make people. That's it. The insurance business in a nutshell is promising people that if you wreck your car, I'll pay for it. Well, some people do wreck their car and they pay for it, but those that don't wreck their car, there's enough profit left that they always bring in more premiums than they pay claims. So it's pretty simple business, really. And that's very much where we want to be, is making promises to buy things we want to buy and making promises to sell things we want to sell. This is very conservative, and boy, you don't see this more than 1 or 2 times in the ultimate options class. I mean, this is very conservative on the aggressive meter. A lot of people don't know you can do this in your IRA, you can do this in your Roth IRA, you can do it in your self-directed IRA. It's conservative because you're making promises that you can keep. You own the stock. So basically we have 2 trades here to look at, and maybe I'll just make this a little bigger so we can look at it. Here on the stock, we're the buyer of the stock, and that's it. That's all there is. You're the buyer of the stock, and so someone over here is going to sell your stock, and so you have stock. So it's that easy. You own stock like this, and then over here there's sellers. So you own some stock, and then you also say, and by the way, I promise to sell my stock, right? Let's just say the stock is XYZ, to sell my XYZ stock at a high price. At a high price. And every time you're the seller, 100% of the time when you're the seller of something, you're going to collect a premium. So this guy right here is going to send you a premium, and he's going to send you some cash and say, and what's he saying on his side of the transaction? He says, I now have the choice to buy XYZ stock from you at that higher price. Now, why would this guy do this is a very logical question. Why would this, maybe this is good for a month. Why would this guy do this? Why would he do it? Well, the price of the stock, that you bought, so you might have given this guy $10,000 for this stock. So to buy the stock costs $10,000. Well, as we said, this premium might be $100. And so, if the stock does go up, let's say the stock is at $100, and let's say you agree to sell it at 110 or something like that. If this guy wants to make money above 110, by owning stock, he's got to fork out $10,000. But here, for $100, what if this goes to 115 and he's got 100 shares? That means he made $500 off a $100 commitment because he has the choice. He's not committed. He's like that girlfriend you had or that boyfriend you had that just wouldn't commit. They just want to keep their options open. You're like, hey, here's a diamond ring. They're like, I just want my choice. I don't want to commit.
What was her name? Wendy.
Yeah, it was Winnie. It was zoology. That's right. It was Winnie Jarvis. God, Winnie getting 2 call-outs in a row after 20 years there. So yeah, I never offered the ring. And we never. Dude, I think I went on one date with her. Dude, that was it. She had one charity. It was charity on her part. You offered her
a Letterman's jacket or something.
I had no Letterman's jacket, dude. I had nothing. Okay, I was a beanpole dork. And the only difference between me is I was a dork, a skinny little dork in high school, and now I'm a heavy big dork after high school. That's the only difference between me. A total nerd. So anyway, God, that's a blast from the past. So anyway, this guy has a choice, and I won't commit. I won't commit. And because he's not going to commit all this, he actually has a pretty low risk of $100, but he has a way low probability, right, of it going that high. Way low probability. So if you want to get really good at options and understanding them, draw stick figures like this, right? You don't have to have cartoons like me. You can get out your pencil and you can draw a guy like this, right? You can draw people and you say one's the seller, one's the buyer. This guy would be the buyer of the call, and off you go, and draw out what's going to happen. As a result of this transaction, you send $10,000 to this dude, and he gives you his stock or her stock. Okay, over here, you're going to make a promise, and you're going to get paid $100 to sell this thing way higher than it is today. So that's pretty cool stuff. Okay, everybody with me so far? Give me a yes. If you just give me a quick yes in there, if you catch that basically thing right here. Okay, fantastic. A truly lovable dork, William says. Thank you. I'm glad I'm a Windy Peppercorn is from The Sandlot. Haven't seen The Sandlot, so there you go. Haven't seen it. Look how everyone's catching this.
Sandlot?
I've never seen The Sandlot. My kids have watched it. Isn't that the baseball movie?
Yeah, absolutely.
So the way this looks in your financial statement is instead of having cash now in here, you've got shares. You've got long stocks. So, maybe you've got 100 shares of long stock, and you've just got that in here. And here you've got this promise floating out here, just like an insurance company. You've got a promise floating around out here for which someone paid you what? Maybe they paid you $100, something like that. They paid you a premium of some kind. And so that brings income in your income column. Now let me show you something pretty exciting here. If you, you know what? I shouldn't take the time. Well, I don't want to take the time to do it, but I think I should. I mean, what does it hurt to do something right? So watch this. Let's just bring up our cash flow from the 4 pillars. And we'll get rid of all this ink so it doesn't cloud our brains here. And just for the fun of it, let's see, reduce this down here. I think I probably have somewhere some little stuff like this. Like if you have 15% on an investment, you can turn $10,000 into a lot of money. And as you play with different percentages right here over your life, if a person has $100,000 and they can make 12, 15%, they're going to wind up. I mean, look at this, $100,000 over a Warren Buffett lifetime. That's $259 million. Okay, so once you get into percentages like 12%, whatever, and you're like Warren, you're willing to do the Warren Buffett thing, you can become. I mean, it doesn't, even at 10% over your lifetime, you get $30 million. You start out with $100,000 and you start doing this, and Warren Buffett's like 90 years old now. So, he just makes this ridiculous. I mean, I guess what I'm saying is the compounding just gets crazy, once you get to a certain amount here, a certain amount. So watch this. Let's say you take Kraft Heinz, just as an example, okay? And let's say, this is one Corey and I use a lot because we trade this stock a lot. And what's nutty about Kraft Heinz is it's gone. Look at it's down. I mean, most people look at this stock and say, Andy and Corey, you're nuts for wanting to have this. You're nuts because it's going down. Are we buying this because of stock price, or are we buying this because of ketchup? That's the question. Do Corey and I really care about the stock price, or do we care about the ketchup that we're selling? And the Weight Watchers, and the Oscar Mayer Wieners, and the Philadelphia cream cheese. And, you can't believe all the brands. This is the 4th largest food company. You type in Kraft Heinz brands. I don't know why anyone wouldn't want to, what brands, bring up some images here. Okay, this is what you're getting here, folks. Velveeta. Look at this right here. I bet you guys didn't know this. Look at everything Heinz and these guys own. TGI Fridays, Ore-Ida freaking French fries. I mean, that right there will keep them in business forever with me. I'll personally finance Fridays and Ore-Ida French fries, okay? They got a lot of cool brands here, and Heinz, of course, is just insanely good. Kraft A1 steak sauce, Kraft cheese, Cool Whip, Kool-Aid, Jell-O. I mean, good gravy. Kraft everything, Miracle Whip, Stovetop stuffing, Velveeta. Where's Weight Watchers? They should be on here. Maxwell House Coffee, Planters Peanuts, at Crystal Light, Country Time, Lemonade. I mean, Jiminy Christmas, what don't they own? Weight Watchers is on here too. And Weight Watchers doesn't even work, and yet it's been around for 1,000 years. So my mom went to Weight Watchers. I mean, Jamie, at Christmas, that stuff doesn't even work. So we're not really caring too much about the stock price. That's what's hard for people to understand why Buffett doesn't care. Our cost basis, this is $28 today. Our cost basis is under 20, right, Corey? Under 20.
That's right. Our cost is under 20, and it's never even gone below 20 on the chart. And you look at that and you kind of say, well, how is that even possible? I think we started getting involved in this when it was in maybe the high 20s, something like that. Yeah. So we basically been.
It was on this drop. We started right
after
here.
After that big drop.
Our first
low
put.
30.
Our first put was to buy it at 30, and it never got there. See, I'm going to put it right up there. Our first put was to buy at 32, I think, and it never got there. We bought it on this dip, I think is where we got it, and then we just kept writing calls and out of the money puts on it since then. So there's two ways you could really look at this, right? There's two ways you could look at this. You could say, well, let's say Andy's and Corey's cost basis is like $19. So let me find my cursor again. Now watch this. Let's say that our cost basis is $19. We're getting $1.60 in, you notice every quarter we get 40 cents a share for the dividend. See this little green dollar sign? Cha-ching, 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 ching. So we're getting $1.60. You divide that by, let's say it's 19. We're getting almost 10% on the dividend right now on the money we've put in. And as our cost basis keeps going down, so let's say we keep selling calls, and that reduces our cost base. In other words, every time I bring in a premium call option, it goes down. So watch this. Let's say we look at Kraft Heinz right now, KHC, and we've just got so much stuff going on this stock. Let's just erase all this stuff. Okay, we got 1,500 shares here. Let's use this as an example. 1,500 shares here. And let's say that we decide to sell a call, and we look at where the stock is right now today, which is like right in the middle here at 28 or whatever it is, okay? And let's go to a simulated trade here, and let's just go out a month. So it's April 14th. We'll go to April 15th right here, okay? And let's just,
May 15th.
Or May 15th, excuse me, May 15th. And let's just look at the chart, right, and say, hey, we got a little resistance up here at 33, a little resistance here at 32. Maybe we're willing to sell it, somewhere around in there. So we come over here to the call side, and we say, well, what about 32.50? And they'll give us the mark. Where's my mark? The mark on this at 32.50 is 36 cents.
36.
Okay, 36 cents. Now think about that for a minute. Watch this. 36 cents, and for every share we want to do this, we got to have $32.50 in there. So divided by $32.50, that's 1.1% for 1 month. See that? 1.1% for 1 month. Times 12 months is 13%, plus the 8% we're getting for the dividend. If you want to, that's one way you can look at it, is that's pretty good percentage on Kraft Heinz. And people wonder how Warren Buffett is able to get those higher percentage. So that's one way you could look at it, is our dividend plus our premium. The other way you could look at it is if our cost basis is $19, you could say, you know what, we just took another 36 cents off it. Now our cost basis is $18.64. You could look at it that way. And you can say, gee, $18.64, well, what's $1.60 divided by $18.64 is a new cost basis now. Now we're up to 8.5. So you could, either way you want to look at it, is you bring in that premium. If you want to look at it as part of your percent return for the year, you can. Or if you want to say, no, it's just reducing my cost basis. We like B, because Corey and I like the idea that if we keep writing calls that, think about it. We only got $19 left to go. So if every month we bring in 30 cents, right? Every month we bring in 30 cents, and it won't be perfect, right? We'll have to buy some back sometimes, and it's not going to be perfect, so keep that in mind. But just think about this: 30 cents times 12 months, that's $3, right? $3.60. So if you only got $19 left to go, and you're getting $3.60, in 5 years we own this free and clear. Well, I'm not a young man, but I'm not an old man either. But I'm just thinking, if I'm just consistent, look, that 5 years is going to pass, whether I do this or not, right? But if I could just inch down and keep collecting those little premiums, those little tiny premiums, and the chances of that happening are actually pretty small as far as getting called out. It's about 17%. So what's beautiful is if you watch the standard deviation on this is going to be pretty cool for you guys to see. If I do sell that call, and I say, yeah, 32.50 is the one I'm going to sell. I'm going to sell it at the mark, which was, what was the mark again?
36 cents.
Yeah, it's down to 34 right now, so we'll go 34. That's fine. So let's go. I've run out of real estate. We've got way too much going on here. So let's look at the risk profile on this. Okay, and I sell that call. Look at this. Here is a standard deviation for May 15th. It's right on the edge. See that? It's right on the edge of it. And so I don't mind being out there like that. I might go out a little bit more to 33 instead of 32.50. Who knows? But I'm right on the edge of what would normally happen. In other words, this has to go clear to the extreme. And you know what? If we buy it, guess what we'll do? We get all that money to start with, right? And so maybe I sell a put at 32 the next month and try to buy it back $1 cheap, and that reduces my cost basis. So I don't mind selling out here at the edge of this standard deviation because it's not as likely to get here. There's about a 1 in 5 chance I'll sell is all. So, 4 out of 5 times I just collect that premium. 1 out of 5 maybe I sell, or maybe it goes up here, and I'm not going to get into deltas with them here, Corey, because the stock has a delta of 1. This has a delta. The option has a delta of probably 6. It's probably less than that, probably 17.
Yeah.
I imagine our delta on this is probably 17. Let's just check it. Our delta on this call is 1742. Yeah. So, I'm still going to make money. I'm just not going to make as much on the stock movement, but I'm still making money on my time decay, if that makes sense. So for Corey and I, it's less about how this stock does itself and more about how much money can we make selling ketchup, reducing our cost basis month after month, and a covered call is a way to do that. How many like this little strategy? Give me a yes if you like it. Brett, I like your idea of rolling out and up. Yep, if it gets up there, I can do that. Okay, and what's crazy is that this is conservative. I mean, this is something that happens in a IRA, and this is what's really funny. My first rich dad was a guy named Lynn Barton, and I owe him so much. I had a friend that I played basketball with growing up, 12, 13 years old. When I got married, his dad was a worked at a brokerage called Dean Witter back in the day, and they got bought out by Morgan Stanley later on. But Dean Witter was where he worked, and he was the richest guy I knew. And he wasn't like insanely wealthy. He wasn't like Robert Kiyosaki wealthy, like, $100 million wealthy back then. But he understood money, and he understood compounding, and he had a good clientele, and he had the benefit of being a broker in the 90s where you could throw a dart at a stock chart and do well for your clients. So when I got married in 1993, my wife and I went to go see this rich dad of mine, this friend, my buddy Red, we called him Red, he had red hair. And I went to see Red's dad, and we made an appointment. I walk into his office, and we have nothing, because we're just newly married, and I'm playing basketball in college and all this. And I walk into his office. He goes, "Number one, Andy, you can't invest if you can't save." He says, most kids your age are starting to learn credit cards now. You can't invest if you can't save. So he says, if you really want to, and he goes, what do you guys want? And we said, we want to be rich. That's what we said. We want to be rich. And he just says, everybody says that, but to be wealthy, you really have to want it and learn it and have discipline. And, kind of gave us a real good talk. And he said, you guys write down a piece of paper how much you're going to save every month towards investing, and then we'll talk. How much of your income are you willing to put into investments instead of, doodads as a young couple? You guys going to get secondhand furniture? Are you going to go to R.C. Willey's and run up your credit card? Like, what are you going to do? And I don't even know how we did this, but we wrote down $500, which for us back then, it was impossible. It was just next to impossible. $500 a month for a young couple starting out in 1993. There's no way we could save $500 a month. But we wrote it down, and we thought we were just setting goals here. The second we wrote it down, he says, okay, come back in a year. And, if you have $6,000 to invest, I'll help you. But you can't invest if you can't save. And he sent us out of his office. Isn't that crazy? So it did exactly what he wanted it to do for us. It didn't piss us off, but it did make us determined, right? That we now, in order to have his help, we had to show the discipline that we could do it. Well, I'll be darned if we didn't do it. We walked in there 1 year later, and we had $6,000 to put in a brokerage account. And that's how we started. Well, we got in some easy stuff, kept some in cash. And right around this time, I got moved up into sales. I started doing sales. And I started working for this company that sold software for trading. It was the 90s. Al Gore had just invented the internet. It was kind of a new thing. And after a time, I learned what this covered call was. I learned what this was at a seminar. And because he had not told me about it, I figured it was probably a scam. I figured it probably wasn't real. But it made so much sense to me in the seminar. So I decided to go see him, and I was really nervous to go see my broker because I thought, I'm probably going to go in there and he's going to tell me how stupid I was going to the seminar and, how I can't get taken in with all this get-rich-quick stuff. But this didn't seem like get-rich-quick to me. It just seemed smart. And I said, hey, I was kind of sheepish about it. I says, I checked out this thing, and I've been selling this software, and that's, what I've been doing the last few months, and new job. And, they do this stuff called covered call writing. And as soon as I said covered call writing, he says, oh, you want to write some covered calls? He says, let me show you the ones I'm in right now. And he opened his computer, and he showed me like 10 covered calls he was in personally right then. He goes, you want to write some in your account? And I said, well, Lynn, how come you didn't tell me about this? He goes, you never asked. He says, you never told me you want to do covered calls. If you'd have told me, we'd have done them. And that's an important lesson because even though he's my friend's dad and he cares about me, he's got 1,000 clients that have six-figure accounts, not $6,000. And so what you'll find is the lesson I give you, that I offer you, is just listen to this carefully as I say it to you. Who cares more about your money than you? That's a great question to think about right now. Who cares more about your money than you? In other words, even though he loves me and we're friends this day and he'd invite me to his daughter's wedding or his granddaughter's wedding, and him and me and Red are still best buddies today. But the reality is when he wakes up in the morning, he's thinking about his financial statement more than anyone else. Even though he's a fiduciary and he has to, put the other guy first, there's a selfish gene in all of us where it's our stuff. So is that a huge lesson? It's a long-winded one, I guess. But that's the thing. Who cares more about your money than you? And so, if you want to write great covered calls, use your team, but be the leader. Don't follow, be the leader. You're the captain of the ship. Your broker's your first mate, right? You're on that ship. You're on the sailboat. You're out on the sailboat and you say, hey, attorney, you're the main sheet trimmer. And, hey, attorney, watch when that boom changes. And you've got this. And you have a team. But you're the leader. You're the leader. So that'd be a covered call. Now, let's go back to, I got so many windows open, Corey, it's ridiculous. So let's draw a risk graph on both a stock. And let's draw this. So let's say I had a stock that I buy at $66 a share. So that means that as long as it stays at 66, I've made nothing, I've lost nothing, right? So at 66, I've made nothing, I've lost nothing. So at 66, I have a 0. And let's say I have 100 shares. Go ahead, Corey.
Oh, I was just saying break even. You're right there.
That's my break even. That's my break even. So think about this. If I have 100 shares and it goes from 66 to 67, how much money would I make? Let's have everyone fill this in so I know you could do the risk graph. Okay. If it goes from 66 to 67 and I have 100 shares, how much money will I make? Okay. So we've got 90% of us got it right. Now a couple of us don't. So I'm not gonna call it by name, but think it through. I have 100 shares and the stock has added $1. So that's gonna be what? 1 times 100 is 100, right? So I'm gonna make $100. Do you see that? So 66, if it goes to 67, I make $100. Why? Well, I have a $1 increase and I have 100 shares holding. So that's going to be $100. Does that make sense, you guys? That's how much we're gonna make it. Okay. Now you bring up a good point here. Keith says, "What's the cost of owning it?" And in the old days, I might have paid $7 to a brokerage, but guess what? Now they want your money under management, so this transaction actually would be free because Ameritrade and all the others have gone commission free. So you have it, and there you go. And if it's in a Roth and you don't sell, either you don't sell or even if you're doing a Roth, it's going to be tax free. So that's good. Okay, now let's say it goes down to 65. How much would I lose? If I go down to 65, how much do I lose? Christopher's got it in first. Very fast, okay? So now I would be down, if it goes from 66 to 65, now I'm down $100. If it gets 66, that's my break even, 67, 100. 68, 200, 69. Oh, look how this works, just like this, and look what I've got. So that, in black, is my risk graph, okay? That's what a risk graph for the stock looks like, okay? Now, let's erase that. So everybody good with that? Say yes if you get that. That's pretty easy, right? Everybody's got that. Piece of cake. Got it. First risk graph, easy to draw, piece of cake.
And Andy, we could even leave this risk graph up and just show the difference between.
We'll do it in a different color.
That and a covered call.
Yeah, Perfect. We'll do it in a different color. So now we'll switch colors and we'll go to blue. And now we'll figure out a call. So let's say that over here, someone says, you say you make a promise to sell at, let's say,
70 maybe?
Yes, I was going to say 69. Fair enough? 69. Well, 70 might make them, $3 will make the math easy as 4. So we'll say we make a promise to sell at $69, and someone gives us a premium of, let's say, $1. Is that okay, Corey? If we make
Perfect.
it $1, and that'll make the math a little easier. $1. Okay. Now think about this. So we already have $1 in our wallet, and we're going to sell at 69. Well, that means
now picture yourself logging into your brokerage account. You log in, you look in your positions folder, and you have 100 shares of this stock. You now click over to the options and you pull up the option chain to look at what they're offering for different strike prices. You look over there in the call side and you find that 69 strike call, just like you would do as a trader. You find that 69 strike call and it's quoting you value, and that value is $1. So it's telling you if you want to sell this, you're going to bring in $1 per share, or because you have 100 shares, $100 in income. So I just want you to kind of envision you own the asset. You can go in and make a promise against that asset. It's a covered call.
Very nice. Very nice. In fact, if we wanted to have fun with this, we could actually make this pretty realistic, but let's just go with what we're doing here. So now what's interesting is we're going to do it separate and then we'll do them together. What do you think, Corey? It's a little different, but that's all right.
Yep.
So let's say it was just this alone, okay? And we know that we'd make $100 as long as it stays where? Below 69, right, Corey? So we come up here to 69, and we have it right here, and at that point we make $100 if it's at 69 or lower.
Lower.
See that? 69 or lower. Now, what if it goes to 70? Well, that's on 100 shares, right? So that's $1, correct, right? And so look at this. That's where my break-even point would be. Because if I make a promise to sell at 69 and it's at 70, it's going to go just like that. Okay. And now I'm short.
That risk graph right there is just showing the short call. We're not looking at the stock. The stock is the black line. If we just plotted out a risk graph for that call option we sold, and it was by itself, all you can make for selling that call is $100, and you're going to make that if the stock is it's at 66 right now today, right?
Yeah.
But if it stays here or is in any of these prices, excuse me, at 69 or lower, you're going to make the $100 because at expiration, that call option is going to expire away. But if it goes to 70, now I have to buy it back. And if I have to buy back a 69 strike call and the stock's at 70, that's going to cost me $1.
Yep.
Well, since I collected $1 and I have to pay $1 to close it out, I break even. Every price point above 70, I'm now paying more to buy my way out of this promise. And that's why it shows losses and it just continues to fall that way. So if you just sold, this would be a naked call, you're not having anything to protect it. You would have a lot of risk if this stock kept going higher and higher and higher. We talked about that early on, where if you just did a naked call and didn't have a protective position, you could only make the premium, but you'd have that big infinite amount of risk. Remember how if the stock kept going higher and higher, you just keep losing more and more money. There's no cap on that. Now, if we combine the two, now, of course, it is a covered call because now you've got the stock to deliver. Now we'll combine these two together.
Now, notice something. We talked about the two monsters last week, that if this one's going down and this one's going up, the net result of this at 69 is probably going to be even. And I'm going to move this up one because I have $100 more for taking the trade. Right, Corey?
Yeah, and an easy way to understand this is to go back to what we just showed in KHC and others. Think about your cost basis. So start with the stock in mind and say, okay, if I bought 100 shares at 66, and then at the same time I sold this covered call at 69 and they paid me $1, what did your cost basis just become? You guys tell me in the chat box. I bought the stock at 66 and I sold the covered call and collected $1. What's my cost?
Yeah,
and I
let's
see
have
it filling
them fill
up.
it
That's
out.
fantastic.
Let's let them fill it out. That's a good idea. Let me scroll down. Yep, everyone's getting it right. So now my cost basis goes where? It goes here, right? So in other words, I reduced my risk by $1. I've reduced my risk by $1. Now my break even is 65 instead of 66, right? Now that's going to be the same here as the stock, right? If I go to 64, how much have I lost? Now I've lost this. If I go to 63, I've lost. Go to 62. So now I have...
And think about the math behind that. Why have you lost? And what, showing the example, if we go to 64, you have a $2 loss in the stock. You bought it at 66. It's now worth 64, but you have a $1 gain in the option. So the net effect is -2 in the stock, +1 in the option. I'm down 1. -3 in the stock, +1 in the option. I'm down 2, and so on. So we get to keep that premium no matter what. And so you'll notice it's kind of a minor hedge because it brought in that extra $100.
Yeah, it's $1.
But it reduces our cost basis. It doesn't truly protect your downside because if the stock goes falling, you only made the $1. If it goes down 5 points, you're still kind of behind in that scenario. But we're in the catch-up business. So that as long as they keep selling ketchup, we're going to keep cash flowing this strategy, and we're going to be just fine. As long as the company is not, mortally wounded, we're fine.
If it stays at 66, I make no money in my stock, but I have made that $100 in my option if it stays at 66, right? Boom. Now this is where it gets kind of fun, because this is pretty easy, because we just moved our whoop, I just screwed that up again. We just moved our line down 1. Now think about this. We're gonna sell the stock, think about this, at what price? 69. So if we go to 69, that's where we sell it, but we still make the $100 for doing that right there, right, Corey? So if we go up to 69, that's where our strike is, okay? Very, very important. But we've already made that $100. We know that we're going to cap our gains at anything after 69. Anything you want to say about that, Corey?
Yeah, exactly right. Because if you, again, doing the math on it, if you buy the stock at 66 and you had to turn it over at 69, you made $3 in the stock, but you also get to keep that $1 in the option no matter what. So 3 plus 1, we're now up to 4.
Let's
so
figure out.
You're always that one notch above.
I'm trying to figure out a question. That would be good. So if the stock is at 69, how much money will we make? 300 or 400? What do you guys think? With the covered call, what will we make? You guys are right. It's going to be 400. So we come up here. We say we're going to make 400. So you can actually build a risk graph if you take it a step at a time. Okay, I bought the stock at 66. I got another $100 for selling a call. Plot it. If it goes down to 65, I'm break even, right? If it goes down to 64, I'm going to lose $100. So now I can make this line just like that. Now I know that at this point, an interesting thing's going to happen, because I have to sell the stock, so that's going to eliminate any upside I have in this stock, correct? Any upside I have is going to be eliminated, because after 69, I no longer own the stock. Right? So if it's at 70, I have to sell at 69. If it's at 71, I have to sell at 69. If it's 72, I sell at 69. So no matter how high this goes, I'm still going to be selling at 69. So that's going to level this off forever that way, which makes a lot of sense.
Yeah, and this is so valuable to show these plotted over each other, because which trade was superior at every single price point, 60 up to even to 70. I'm going to call it 70 because at 70 you're break even. The covered call is superior at every price point, right? That green line either has less loss than the black line, just holding the stock, or it has more gain. But notice there comes a spot where that changes. And this is where covered calls, if you think about what you're giving up for collecting the income, you're giving up potential upside. And so it's important you understand that if this stock were to absolutely explode higher, remember that black line keeps climbing and climbing and climbing, and the covered call flattens out. It caps your gain. And this is why I said that risk management, you might say this is not a stock that I'm willing and really want to part with. So we could be prepared to take action to maintain our stock, to basically hedge this covered call up there at 69 or 70 at those levels where we don't capture the upside, and we might buy it back. We might roll it out. We might delta hedge. We might do a few different things like we've talked about to basically say we want to capture that upside. We want to stay in the ketchup business. But it's important to understand that transition point where if there was an explosive move, the covered call could miss out on the upside. And that's where people ask, and you touched on this, you made a great point. Why would somebody buy that call that's way up there? Because they want that huge upside. They're paying a small premium for that big upside. Now, they're taking a bad probability trade, but every once in a while it could pan out. It's not a good idea to be a buyer of those out of the money options, but nevertheless, people will continue to buy them. So
two things to catch on, or three things to catch on this. Number one, when I would run into stuff like this, my brain shuts down, okay? I'm not that good at that. My brain isn't that fast. And let's just say you guys kind of gotten to know me a little bit right here. How many think that the first time I saw this, I was like a duck in water and I just knew it and I was perfect and I never had to work at it and it was just a piece of cake? You think so? You think it was just, oh, I love what Mary says. Everyone's laughing. Quack, quack. Kevin C says, quack, quack. Let me tell you something. I was completely clueless. And the problem I had is I was not very good in school. I struggled in school mostly because I'd panic. I remember when I went into college, I didn't know what I wanted to be when I grew up. Nothing sounded interesting to me. My buddy was going to pharmacy school, so I thought, well, I'll go to that with him. And I hit organic chemistry, and I realized, I did not know if there was a God back then, but once I took organic chemistry, I knew there was a Satan for sure. So I figured there must be a God at that point because organic chemistry was invented by Satan, if you don't know. He invented it to afflict and torment man. And so I'm in this test in organic chemistry, the first quarter, of the first exam of the quarter, and I get to page 27 before I find something even remotely familiar, and I failed the exam, obviously. And I remember going to class, and if I had the experience of not understanding something, I would panic because I think I'm not smart enough. I'm not smart enough. And I knew the quiz was on Friday, and I knew that if there was any moment in class I didn't understand something, it just meant instant death on Friday and ineligibility to play basketball. And why did I take these classes that are too hard? Because all I want to do is play hoop and date girls, right? That's what I wanted to do. And so it was tough. And what really helped me is when I realized that was a habit that formed in my brain. And when I saw something was a little more complex than I was used to, I learned to take a breath and I just tell myself, there's no test on Friday. And I get to learn this because I want to, not because I have to. And even though I might not be as smart as the person sitting next to me who's getting an A in this stuff and is like a duck in water, I can make up with it with time. Even though, look, they might have gotten to this point. Let me take a picture of this so we don't lose it because this is an important risk graph. So, because I don't want to lose it. But, maybe this person learned this quickly. They got from 500 to 0 this quickly. And you know what? Maybe for me, maybe for someone else, it looks like this. And maybe for me, it looks like this. But you know what? We can all get to the same place. Might take me, 72 hours to learn it. Might take someone else 60 hours to learn it. But we can all learn it, and there's no test. We get to do this in a paper trade account. We get to do this in a practice account. So the first thing I'll ask you is, do a little attitude on your own attitude check. I'm sure you guys are great because you just are. Best commentary right now, Coach. Thanks, Keith, because I've been there. Right? I've been there. I 100% been there, right? That's why God invented hemp. That's what Donald says. That's why he invented hemp to counteract Satan's organic chemistry. But the reality is, if you think that this was something that I took to the first time I saw it, nothing could be farther from the truth. And so now I'm going to tell you, I said I had 3 things. That's the first one. The second thing is a story to give you a little bit of comfort and hope on this. So Corey and I have a mutual friend who is a fabulous stock trader and options trader, and his name is Rob Reinhold. And Rob Reinhold used to take people under his wing now and again, and he charged about $10,000 for a good mentorship one-on-one with him, and I knew him kind of through people that I knew and was not a student but a friend. And I said, Rob, you teach this and mentor people all the time. You seem to have figured it out. Could I get some time with you to do this, and I'll pay you to do it? I'll pay you the 10 grand or whatever it is to do it. And he said, oh, Andy, just come up to my house. And he's so gracious. He was so nice. And he pulls out a piece of paper at his kitchen table, and he starts drawing stuff like this without even numbers on here. He just starts going, Okay, that's what it's going to look like. And he did it that fast. He did it that freaking fast, just right there. 400, just boom, just like that. And quite frankly, I was just astounded that I thought this guy was a savant. I thought I had the Rain Man right there with me, this savant that could draw these wrist graphs so fast. And what I didn't realize at the time is the difference between he and I is, yeah, he is smarter than me, but most people are. But the bigger difference is he just done this 1,000 times, and I hadn't done it 1,000 times yet. I hadn't done it yet. And I was so grateful for him taking the time. And I said, all right, let me write you your check. You've taught me so much. Thank you. And he wouldn't take anything. And I just didn't feel right. So I went down. Back then there wasn't anything 10 grand to buy him. So I went down to RC Willey's and I bought him back then they were like $5,000. Now you can get them for, a tenth that. But back then, a big screen TV was a big deal. And so I bought him a big screen TV for $5 grand because it meant a lot to me, right? That Rob would take that time to do that. And Rob, Corey,
yeah.
He's just great guy. So that's the second thing is whenever you watch someone that's done this before, it's going to seem, a lot. So that's the second thing. The first one is, look, don't take discouraged. And then the third one is, how do you feel about learning these on your own speed, at your own time, in your own practice? Does it sound like something that's going to, oh, crap? Or is it like, hey, this is a skill? And for me, I was like, wait. This is pretty smart. I'm not going to let myself, it was a lot like when I found my drums. It was very difficult to do those sticking patterns and all those rudiments when I took drum lessons. I just wanted to be Neil Peart, right, overnight. But I found something that I liked and something I could do at my own speed, my own time, without having to have some crazy professor that really was there just for tenure and for a job rather than being excited about getting better. So here's your first key. How do you do this? Well, I'm going to buy stock at $66. That's my break even. If it makes $1, I'm here. If it loses $1, I'm here. And I start with a stock risk graph, right? Then I get rid of it. And I say, what would happen in this covered call? Well, I know that I'm buying the stock at 66, right? And I know that I'm getting another $100 right there. So if I lose $1 now, I'm at break even. And so I can draw my line. That's simple, right? I know that at 69, I should make $3, right? I should make $3, but I know that, if I bought at 66 and I promised to sell at 69, I know I'm going to make $3, but I know I make an extra 100 from the covered call. So that'll be 400 total at there. And then I know at 69, if it's 70, I still sell at 69. If it's 71, I still sell there. So there's my graph. And it looks just like that. See that? With the break even. It looks just like that. There's my break even. I guess I could dot that line like this, right? There's my break even line, and that's my risk graph. So you can actually begin to identify these by their risk graphs, right? That's what the risk graph looks like of a covered call. It looks like that. So one last time, learning this. 66, one more, because I got an extra $100. Boom, got that line. 69, I make 3, one more with $100. Got that line, off I go. There's my covered call, that quick. So you will not be that fast today, but you could be that fast. I guarantee you could draw this graph that fast with a week of practice, with 1 week of practice. So the decision is pretty cool. Do I want to learn how to do this trade and the benefits of it throughout the rest of my life if I take 1 week and I practice drawing those risk graphs, right? And that's really how the Ultimate Options goes, is we give you 1 a week to learn, 1 a week to learn. And if you follow what we say and follow the practice, what we found is people do learn them, and they feel a huge sense of accomplishment once it clicks, and once they get it, they're like, okay, I got this. How many like drawing the risk graph rather than cheating with the software now? You starting to like this a little bit better? Starting to understand a little bit better? Okay, Axel likes, we got Axel back. Axel Gravens Broughton. Gravensbrotten. Okay, so this is cool stuff, right? This is cool stuff. Okay, so yeah, we can do this now. Raleigh asks a question. Can you do other things other than this? Well, yes, you can. But for now, what's important, because everyone's going at a different speed here, is understand that this is how it worked. I'm really spending a lot of time coaching you on the academics of this and how to approach it, not like a college, but more like learning for the sake of learning, not to get a grade. But I really struggled in mathematics, bad, really struggled. For some reason, when I got into my sophomore year or my junior year of college, something clicked for me. And I took a calculus class and something clicked for me. I realized that I needed to have 4 skills, and that every crazy, integrated, nutty problem they could give me was just a whole bunch of little problems of being able to add, subtract, multiply, and divide. Square roots were about multiplication, right? Fractions were about division. I've realized when I could break down a problem into those 4, I could do any problem that I wanted to. And all of a sudden, I started getting better grades in math for some reason when I realized that I looked at it in parts. Well, let me tell you what you can do in this. You can buy stock, or you can sell stock. See that? You can buy stock or you can sell stock. You can buy a call option, or you can sell. Whoop, wrong color. You can sell a call option. You can, let's get violet in here. You can buy a put option, and do I have any more colors left? Sky blue. You can sell a put option. That's all you can do is those 6 things. That's it. So any trade that Corey and I teach you in the future, right? Any trade Corey and I teach you in the future, you'll say, okay, which of these things are we doing? Which of these things we're doing? So I'm going to give you a quiz right now, and I'm going to ask you, which of these transactions are we doing when we write a covered call? Just tell me which one we can do. Rashish, that's what this one is, right? If you're shorting, you're selling stock. Yeah, so you're selling a call and buying stock. That's it. So we would say, all right, so a covered call includes buying stock, right, and selling a call. Those are the 2 we did. We bought some stock and sold a call. Okay, how about this? What about that iron condor on gold we did? That's a little tougher. What did we do? Well, we sold a call for income, and we bought a call for protection. And we sold a put for income, and we bought a call or bought a put for protection. So these 4 were the iron condor. You follow that? And so there are unlimited, well, I wouldn't say unlimited, but with these 6 things, you can do so many things now. And you guys remember how we wound up with those risk-free graphs, that some of them we even got risk-free? Well, it's because we have the right combinations of adjustment in buying calls, selling calls, buying puts, selling calls, buying stock and selling stock. So it's one of those 6. So hopefully that helps. How many are liking this session? This has been a good one?
Andy, that's a great point in breaking it down to those 6 things, because simplifying it is basically putting yourself in the definition of what these things are. So you got to think of it from the standpoint of, when I buy a call, I have what? And think about that definition. We write it out often. I have the choice to buy at this price. And so get those in your notes, and every time you consider a new strategy, talk to yourself. If you're on the train, it might sound a little weird, but who cares? Talk yourself through what your choice is, what your promise is made, and just really break that down, because again, it comes back to those 6 things. Every strategy you do comes back to those 6. So as you get what seems to be a little bit more complex, It's just a combination of choices and obligations. That's all it is. Choices and promises. The person making a promise gets paid a premium. The person that has a choice pays out the premium. And as you start to put yourself in that and use those definitions, it'll just get clearer and clearer. It's just practice, and everybody has to work their way through it, and we all move at a different pace, but I guarantee you everyone on this call can absolutely get it and be drawing risk graphs on their own freehand in relatively short order. It's just, you'll have to practice and work through it.
Okay, so let's check this out. When we do this, and this is just one of the, what we do in Ultimate Options is we just take one trade a week, way slow, just like we've done here. And we're going to use a little example here. So here's a stock at 51.72. Here is our option chain, right? And we say, let's do the 4 pillars, right? We go through the 4 pillars. So for a covered call, we probably like something that's a little bullish, but not too bullish. We like a strong sector and a strong company. And if we have a dividend paying like Kraft Heinz, we get to double dip. So we really like dividend stocks for this type of thing. So we look at our valuation measures, and hopefully this is starting to look familiar. One of the reasons I like people to be in the 4 pillars class before they try something like Ultimate is because they'll have a sense of what this stuff is, right? And then we look at technicals and we see, okay, we definitely have higher highs here, right? We're looking pretty good. We got a little overhead resistance here. That might be perfect for a covered call. So that's good. For cash flow, we don't care if the price goes up, down, or sideways. We're collecting premium. Okay, time is going to decrease, and volatility, if it decreases, is nice. And then we go through it. We go through it. Trading journal, drawing the risk graphs, the whole bit. One great way to do a risk graph, if you want a formula, this is the formula we use to help people in Ultimate Options, is if you'd like to draw these risk graphs better, let's do this one. Let's do a $53 stock, okay? So the price is $53, and let's draw our little guys here. And one guy does a promise, and one guy has a choice to buy this from you, and you're going to make a promise to sell. So he has a choice to buy. And let's say in this one, he's going to give us $1. Once again, $1 is just easy. Okay, now watch this. So we're buying a stock for $53, and we're selling a call for $1. Okay, so watch this. Let's start right here with our break even. Okay, what is our break even? Who can tell me? What's the break even going to be? Think about it. If I buy the stock at 53, but I'm getting another $100, right? Because it's $1, 100 shares. So where's my break even? Let's see how everybody's doing. So here we go, 53 here, but we know we have $1 or another 100, so that gives us a cushion. So our break even is going to be at 52. So we write that up there. Okay, we just write these before we try to do on a loss here. Now, we're going to sell this at a strike price of let's say 56. So we're going to do this at $56. Now let's think about what the most we could make is. The most we can make. If we buy at 53 and we sell at 56, how much do we make on the stock? Right? 53 we bought it at. We made a promise to sell at 56. So think about, if you buy at 53 and sell at 56, what's your profit? Plus, you get another $1 for this. So on 100 shares, what's the most I can make now if I do this? On 100 shares, what's the most I can make? You guys are fantastic. Okay, so the most I can make is this $3 plus $1 is $4. $4, 100 shares. So my max profit is $400. Okay. Now let's look at how much I can lose. Okay, our max loss. Well, if the stock went to zero, I could lose the $53 here, but I brought in $1 here. So what's my maximum amount? If this goes bankrupt, what do I lose? I lose $52 times 100 shares is 5,200 as far as go. And that's not going to be on our chart, okay? Now let's just plot these points right here just for fun. Watch this. My break-even 0 point is going to be at what price, everybody? You guys are already ahead of me. Look at you filling this out beforehand. This is beautiful. It's at 52, okay? So I'm going to make a break-even point right here at 52, okay? What is the most I can make? At what price is the most I can make? I'm agreeing to sell it at 56. What's the most amount of money I can make? 400, and what price would that be at? $400 at what price? 56. So I go to 56 and I go up to $400. How much do I make at 58? Remember what I have here. How much money can I make at 58? Right, that's it. So at 57, 58, 59, I know I'm maxed out there, right? Okay, now think about that. There's your risk graph. So if you can get these 3 points right here, I'm fantastic. Now, we'll worry about target profit and target loss. That's more about where we think the stock will go in delta. We might say, you know what, if this gets down here, we might not be comfortable, we might exit. Or, you know, we actually would like to be up here and just do it again. We don't want to give up our stock. So, but if you can get your max profit figured and your break even figured, and of course this will go down here, you can pretty much draw any risk graphs that you want to draw. And what's cool is in the ultimate options, we do this on every single strategy the same way. In other words, when we hit this page after we've learned the strategy, before we try to draw the risk graph, we identify our break-even point. Where is it? 52. We get our max profit. It's going to be $400 at whatever it was, 56 or 7 or whatever it was. And then you can draw your risk graphs much easily. You guys like that little technique? Thank you, Teresa. She goes, this is so interesting. Nice teaching. So that's really cool. So what's cool is, Dana, you're exactly right, is this is a beautiful question by Dana or Dana, I hope I'm saying it right, is, you know, whatever that risk graph looks like, you know, let's just draw an arbitrary one. We know that a covered call risk graph, how come that won't erase for me? There we go. We know that a covered call risk graph looks something like this, right? So she's exactly right. If 55 is our or if 56 is our strike, and the stock's at 55 or 54 or 53, this line goes away because it expires, and you're exactly right. You're back to owning your stock. You get to enjoy any gains after that. And if it goes up here, what do? You write your covered call just out of the grasp. What I love to do is I play this game with my kids, where it's getting harder with my other son, but I play this game with my kids that looks something like this. I'm 6'8", and they're still teenagers, so I'm still a little bit bigger. But this is what I used to do. Here's Andy.
And they're still bigger than me.
Yeah, here's Andy, and like here's Zach with his arms up like this, you know, like this. And Dad, I take the basketball way up here. And when he jumps up to get it, I move the ball up where he can't get it. And when he comes back down, then I bring the ball back down. And he jumps, and I bring the ball. And I just keep it out of his reach. Everybody see that little game? Just dangling that thing in front of people. Just dangling it in front. Well, that's what I love to do with my strike prices, is I like to throw out a strike price that's just probably outside of how high the market can get. Just outside. It almost got there, but it didn't. And Dana, you're exactly right. Dana, is it Dana or Dana? I don't know. We got to figure out the long A here. But Dana Hawthorne, you're exactly right in that if the time runs out, you keep the $100 and you've still got your stock. And what would you do, everyone? What would you do? Nice, Donald. If the time ran out and the options expired, what would you do? You just do it again. Dangle it again. That's exactly right. Yeah, you just do it again. Yep, that's exactly right. Yep, just do it again. Wash and repeat, rinse and repeat, lather, rinse and repeat. Everyone's got the shampoo analogy, like 5 people. That's fantastic. So that's the covered call. So why don't we do one to finish up, Corey? Why don't we just crank this out and do one?
Love it.
We don't need this anymore. I guess I could show one more thing. We won't take the time to do it here, but in Ultimate Options, what we do is, first of all, we show you the actual stuff. You guys already know how to do that as review. We go through all 4 pillars, and what's really cool is every single strategy gets a 4 pillars template to where, okay, this is what we're looking for in the fundamentals. This is exactly what we're looking for. Bullish patterns, like a cup and handle be a bullish pattern. A stair step, support and resistance would be a bullish pattern. An inverse head and shoulders would be a bullish pattern. A ascending triangle would be a bullish pattern, right? You guys learn all this. That's why having 4 pillars under your belt is so important before you try and take this. And then we show you the cash flow. You buy a stock, sell the call. This time we did out of the money. Buy the stock at the support, sell the call at resistance. Now this is important. Why do I sell the call at resistance? So if I have a stock that looks like this, and I buy the stock here, and I sell the call at resistance, why? Anyone know why I'm selling the call at resistance? Because it's just out of reach. You got it, Yilmar. It's just out. Yeah, you're dangling. Oh, it makes that carrot nice and juicy. Keep it just above. You guys are nailing that one. Nailing that one. So that's like the Morgan Jeweler diamond play of the game right there, baby. That's fantastic right there. Just a little bit out of reach for you. Just a little bit out of reach. Why are we selling? Let's see how smart you guys are getting. Why are we selling 6 weeks or less? It's like buying what? What do I always tell you? Why are we selling 6 weeks or less instead of 6 weeks or more? Same as when you go to the grocery store and buy what? Oh, it does a body good. You guys got it. Dang. Booyah. You guys got it. This is the milk thing, right? This is the milk thing. Very, very good. Okay, it's coming together. Look, even if you're only halfway there, it's coming together. You guys are totally coming together. And then we want a low delta, which means, remember when I said low delta on this KHC? I took a guess and got lucky. I said, Corey, you know what? It's probably about a 17 delta. Very small chance I'll get called out. This also has to do with dangling. There's only a 17% chance that I'll have to do anything with this, adjust or keep my promise. So a low delta means I probably will let it expire. Just like Dana said, she goes, well, if it expires, I just keep the premium, move on. Yep, 70% chance. That's the 83% chance it expires, 17% chance I have to mess with it. So low delta. So all this makes sense. And then we talk about, well, we let it expire, right? We can buy it back. And we have all our exit strategies, all the different things we can do to adjust. And then we have you practice by doing this every week. And we have you do 6 a week. So you do, like the next day, you do all these, and then you just learn it. You just learn it. So anyway, that is the covered call.
Love
and it's absolutely awesome. So next week, let's do one. Let's find one.
I was going to say, let's do one. And I want everyone to take out in their notes, let's jot down some numbers, and then let's go build it ourselves, and maybe we can throw it back in Thinkorswim after the fact to kind of look at it. But let's jot down some numbers. So in your notes, hypothetically, we go in and buy KHC right now, and we're going to make it simple math. So we're going to buy it $28.50. Give us a nice round number.
Okay, so you want to do a risk graph on it first? You want to do this?
Well, let's look at the options and just write down some numbers. So we're buying the stock at $28.50.
Hang on,
and then if we pull up the options.
So hang on, let's write this down. So the first transaction we're going to make is we're going to buy 100 shares of KHC at $28.50.
Yep.
You good with that? Okay.
And if we pull up the options, we're going to dangle an option out there. So we're going to go out to May, which is a month out. Notice 6 weeks or less. And we're looking at that 32.50, which we've discussed. That's a low delta, 17 delta. And let's use this simple number.
35?
Let's say it's paying us 35 cents. Okay, that's in between that bid-ask spread. So we're going to sell the 32.50 calls for 35 cents of income. And this is important that you write that in your notes.
So
That's
we're going
called
to make
an
a promise to sell.
covered call.
We're going to promise to sell KHC. There's Noah Davidson trying to get in and make adjustments. Sorry, Noah, but we're in here, bud. This is our deal here. Sorry, dude. Oh, now it's telling me I don't have a good password? Come on. Okay, sorry, Noah. We're in here, bud.
So we promise to sell.
Hang on. What ones are we doing here? I got to go back to KHC here.
Yep, you're good.
Come on.
Oh, you got the / There you go. May 15th. So it's a 1 month option.
Right,
we're making a promise to sell KHC for how much?
35. We're going to split this.
Yep, $32.50 per share. That's the strike price. So we make a promise to sell at $32.50, and we're getting 35 cents of income. Okay, and these are the numbers that we need to be aware of. How much money we're receiving in premium is 35 cents. What our promise is, remember, somebody else is buying that from us. There's a market for this. That's what that option bid-ask column shows you, buyers and sellers, and they'll constantly have buyers and sellers for the options that you want. So we went right in between. We went about middle value between where the buyer and the seller is and collected 35 cents. Yep. Now, with all those numbers, we now can build a risk graph. We have the details that we need. And I'd like to quiz you a little bit here, and we'll walk you through it and build this together. So if we bought 100 shares of stock,
I'm gonna do this a little different.
I was gonna say, while I quiz them.
Yeah.
So if we bought 100 shares at $28.50, and we got paid a premium, what is our potential break even? Now think about your break even or your new cost basis. Another way of saying break even. What is our new cost basis or new break even? How much did we reduce our cost basis down? And I see those numbers filling up. So what we have to know in order to get that is think about the premium that you received versus the price you paid for the stock. And we just do the math behind it. If we bought the stock, and I love it, we bought the stock at $28.50 per share, and then somebody just paid us 35 cents per share back. You know, think of it like a house example. Here's a good house analogy. If you bought a house for, or some asset, a car for $2,850, but then you rented it out for a day for $35, you just reduced your cost, right? You just generated some income. That's the same thing here. We bought the asset, and then we sold a call which paid us back some money, so that reduces our cost from $28.50 by 35 cents. So everybody put in $28.15, and that's what we call a break even or a reduction of our cost basis. Now as we come into the risk graph, we have some
now
nice
how good
numbers.
is that right there? Okay, that's the fastest I've ever typed in my life. Okay, all right,
love it. So now on your risk graph, we're going to mark the break even, and all of you would do this.
Okay.
You'd find the zero line.
What's my break even again, everybody?
And everybody said 28.15. They typed that in. Okay. So we need to find 28.15 and mark that zero. That's break even at expiration, right?
So
if we're
right
at
about 28.15. You good with that?
Right there. Perfect. Right there is our break even. Now, if you have a new cost basis of 28.15 and you've made a promise, what is your potential sell price if the promise comes due? Where's your exit price? In other words, what are they going to pay you if they take your stock away? You've made a promise to sell, but only if it gets up to that price or higher, and you're going to get paid that money. So I see it filling up where our potential sell price is $32.50. So now we can do some math behind how much money we're going to make. This is our max gain. Here's your equation. If you've got a covered call sell price, that's your strike price of $32.50, and your cost basis is $28.15.
Well,
we can
okay,
do
I
a
was
little.
going to do it different, but that's fine.
Yeah, 3250 minus the new cost basis of 2815. What's the max amount that we can make? And that's your equation, right? We buy the stock for, now we have a cost of 2815, and if we have to sell it at 3250, we made 435. So 435, and I see that coming in. Okay, we'll do the math. 3250 minus our cost basis of 2815 equals 435. So we can write that under the max profit area, right? We can come up here to max profit and say 435 is our maximum gain. Now that's $435, right? Because it's 435 profit per share, and we're assuming we bought 100 shares. So times 100 shares, we'd make $435. So now we can look at this profit and loss graph, and we know the level at 3250, we make 435. So we need to go up above 400 to the 435 mark and mark that perfect, right above 3250, right above that 400 mark. So do you see that $435 profit? Now, let's ask another question. Well, what if it goes to 33, 34, $35 per share? Can we make more money, or is that our maximum profit? Love it. Okay, we can't make any more. I see the nose, I see we're capped. So it doesn't matter how high it goes, does it? We've capped our gain. So the risk graph would look like that. It would just display that no matter how high the stock goes, we're capped at our $435 profit in KHC. Now, we can also just come in and basically connect these lines, because in between our cost basis and our max profit is where we're profitable, right? So if we just connect the dot, that's all the risk graph would look like, is that in between those, we would make some profit. And then, of course...
That was terrible. Let me try that again.
And that's what the risk graph is going to show, is that if the stock were to fall at, think about just out of reach. What if the stock were to land at $31? Just plot some level. Well, at 31, how much would you be up?
$300.
Well, if your cost was $28.15 and it's at 31, you're basically up 31 minus 28.15. Now, do you have to turn over your stock?
No.
At expiration, if it's at 31? No, we don't. Remember, they only call it away if at expiration it's up above 32.50. So any price below that, we get to keep the premium and we get to retain our stock. So we have this big profit window, and hopefully it does just that. Wouldn't it be lovely if it goes up there and finishes at 31, 31.50, 32, something like that? You'll have had upside in the stock. The covered call will still expire. You reduced your cost basis. And what would you do the next month? Turn right back around and throw another one out there, maybe up at 35 this time, or 37.50, or you choose a high level that's out there, just out of reach, bring in another premium, and just wash, rinse, and repeat. Pretty cool stuff.
Way cool stuff. Now, let's test ourselves, Corey, and let's just see how well everybody did to finish up, okay? Let's do a risk graph. Here's our risk graph that we just drew right here. That's the one we just drew. I just took a picture of it. And let's do this. Let's say that we buy this stock right here. If I can get, boy, this is such a mess. Okay, let's buy 100 shares of stock right here, and let's sell a call at $32.50. And let's say that we bought this at $28.50. So I'm just going to bump that up a penny if that's okay with everybody. If it'll let me. 50, $28.50. And we're going to get, what do we say we're going to get out of that?
35
cents is splitting the spread. So we'll shave that spread at 35. And you know what? Let's get this at $27.50, about where I had it. And get this out. What do we end up at? 34 out here. And I'll tell you what, man, that's not too bad, huh?
Did we do pretty good?
That's not too bad, is it? That's pretty darn close, I'd have to say.
That turquoise line is at expiration. Remember, that's exactly what we drew, is where you'd be at expiration given where the stock lands. So if the stock's at, like we said, 31 or 32, look at that turquoise line, how we're just under the strike price, but we still have a nice profit, and that covered call would expire worthless. It would go away. Now, if we happen to get above 32.50, now here's the thing. Remember, we're selling at a great price. We're selling well above. So some traders might say, well, would you ever just turn over the stock at 32.50?
Look at this right here. I'm just going to see if I can do this. Like, how about that, dude? That's pretty darn good right there. Okay.
Overlaid. There you go.
We have overlay skills here.
Yeah. But would you ever turn it over? You know, if the worst thing that happened to you was that you bought KHC this month, of course, in your paper trade, and you had a cost basis of $28.15, and next month you sold it for $32.50, and you made $435 on your $28.15 investment, you made 15.5% for the month. I think worse things have happened to you.
Yep. One thing
in your life, if you got called away from your stock and you made 15.5% for the month.
You know, if you bought this at $28.50 and that was your break even, okay, and then you had a graph that looked like that, whoop, that's terrible. I got to draw better. And you had a graph that looked like this, okay? That's the stock graph, because your break even would be at $28.50, right? You don't have that 35 cents here.
That's right.
Corey makes a good point. Is the covered call is a better trade at every single price below $32.50. At every single price below $32.50, the covered call pays you more and has less risk than owning the stock. The only way this is not better is in this area up here if it really takes off. Well, look at KHC's personality now, technically, right? I mean, if I thought KHC was going to double in price this month, I wouldn't do this. But if you look at KHC's personality, knowing that the covered call is a better trade with every single price below $32.50, and then I say, well, where is this most likely to be, right? Where is this most likely to be? And I look at my probabilities at that date of May 15th, and I say, it's probably going to be, 81% chance it's going to be in this area here. There's very little chance. So I'm dangling the carrot, right? I'm dangling that carrot out there. I mean, this thing's probably not going to 65. If you look at how it's moved, it just doesn't move that much in a month. So that's how that works. Was this a good session? I sure enjoyed it. I love teaching with you, Corey. Fireworks going off.
Such an incredible group. Such an incredible group. And I do have to apologize if you ever, and I said this before, if you ever type something in and it doesn't get a response, there's just a lot of questions, a lot of comments. So we try to answer everything. Just keep, put in another question or repeat it a couple of times, because a lot of times it gets lost in the Q&A. But everybody's been so patient and just so good. It's the best group I can ever remember. Okay. Awesome stuff.
So watch this. Let's do the last part of this is, let's say I want to do this in one trade. And I say, you know what? Here is covered stock. You could call it that. There's a lot of different ways to do it. But let's just click on this right here. And let's go to 35. And let's do the sell trade right here. So we're going to buy, look at this. Oh, I did it backwards. Right, Corey? That's hilarious.
Yeah, and that would actually show you how you could get out of the trade. So we had questions, well, how do I ever get out of the trade? You literally just do the opposite of what you did to get in. Yeah. So getting into the trade, we would buy the stock and sell one call option.
Yep.
And we could do it for...
And what did we say our cost basis was going to be?
$28.15. So we could tell the market, we want this whole package. We want to buy the stock and sell that covered call for a total cost basis of $28.15. And we could send it in as a packaged order where neither one goes through by itself. We don't get the stock without the covered call. We don't get the covered call without the stock. We can send it in as a full package covered call.
That's
Pretty
right.
cool stuff.
So what I do now watch this. This is for someone saying, Andy, would you actually buy it here? So watch this.
It was actually the 3250 strike, it looks like. So 3250, yeah. Thanks for that catch.
Right there. Okay.
There we go.
here's our risk graph. Exactly like we talked about, right? There's our risk graph. And so now all I got to do is right click, confirm and send. If I like what I see, which I do, I can hit send in the trade, and all I do is hit send, and then you're in. There it goes. So that's it. Interesting here that this recognizes that this is a covered call, and I can click this and create shortcuts and all kinds of cool stuff. I can come back here and edit the trade and say, hey, I actually would like this, down here where I get more money, and I could, finagle them, and then hit confirm and send and do it that way. So that's pretty simple. And if you struggle with that order entry, again, take that beginning investor boot camp where we go through that, and just practice. Okay, last question. I always ask the same one. How about this? What's the best way to get good at this? What's the best way to get good at this? Oh, you guys got, and where do we practice? Fantastic. Beautiful. Okay. I had one more question. Someone says, if it gets to below $28, now what? Let it expire and write another one, right? Anything below that is good for us, right? Let it expire, right? Let it expire. This is fantastic. Dana, you say you've been doing that. That is awesome that you're practicing. I absolutely love it. Doesn't matter what brokerage you use, it'll be the same type of idea. Some choose to use this when they start just to follow along with us, but you can use Interactive Brokers, you can use anything you want. So fantastic. Okay, last thing, I'll dangle a carrot. I promised I'd dangle a carrot. So would you guys like me to dangle a carrot for Ultimate Options? I can do that if you want. Let me take a picture of this. I asked Mike on my team to give a steep discount for the rest of the week on this. So I'm going to show you this, but you have to go to this website to get it, and you have to type in this code. Now, there's a couple places you can buy this. If you go other places, it won't work. You can only get the discount here. So take a picture of that, and we'll let that up for a week or so, and you put in the discount code ULTIMATE. So you go to ultimateoptionclass.com, put in the discount code ULTIMATE, and we'll take $1,500 off for those that feel like, you know what, I want to do that big Ultimate Options class. Now, I'll give you a little warning with that. This class is painstakingly slow, like Corey and I teach, like lots of repetition. But what people like about it is, we didn't just throw this together. We really thought through the Ultimate Options class. And what you're going to find is the reason it's effective is because no matter which one you open, if it's a strategy, it's going to look just like this. If it's a strategy, the first thing you'll see is the risk graph. We'll define what the strategy is. We'll show the objectives of the strategy and where it is on the aggressiveness meter. We draw out what the transactions look like, whether it's 2 transactions, 4, 6, however many. Remember, you can buy and sell stock, buy and sell calls, buy and sell puts. So however many of these stick figures we draw. Then we show you what it looks like on the balance sheet, and we draw the first risk graph. That's the first time we draw it. Then we take an example of a stock with a options chain, and we do fundamental analysis on the stock. We do technical analysis on the graph. We do cash flow, and we actually fill in something we didn't do here. We did a little delta. We had a 17 delta on this one, but we also do the theta, the vega, the volume, the open interest. The probability we had was about 80% probability on this one. We had a strike of 32.50 and an expiration of May 15th and a premium of 35 cents. The long stock was KHC, 100 shares, the short call, 1 short call. We fill that whole thing in on every single strategy we do. It's the same. And the reason that is people start to learn it quicker because it's the same process every time, same options chains, right? And then we do the trading journal section where we go in and enter into the trading journal, and then we have you guys do our risk graph again twice. So we do it up here initially, and then we do it here again like we did today. Then we show you how we enter the order. We give you, this is one of the most important things, and you download this. Make sure you download the manual, because that right there is your snapshot for a covered call strategy. A lot of people say, Andy, how do I know when to do a covered call, or when to do a naked put, or when to do an iron condor? Well, when you go through the 4 pillars and they look like this, that's your strategy, right? It helps us know what strategies might be cool for these market conditions. Then what happens is you get a paper trade assignment every week. We have you do 6, just like my wife does a bunch of sets in the gym and looks good. We do sets here. And we actually take you through the one we did here, and then we let you do 5 more on your own for the week. And then that's the lesson. So every single one of the strategies that is here, right here, where is it? All of these strategies, whether single, verticals, call ratio backspreads, calendars, right? Straddles, strangles, covered calls, condors, butterflies, all this stuff right here is covered in the classes. And we call that the Ultimate Options class, where people can learn how to do, fun stuff. So where'd that go? So that, I promise you guys I'd give that to you. You can put an Ultimate, and you can go there for $1,500 off what we normally sell it for on the web. So that's cool stuff for those that want
Andy,
it.
is there a certain amount of time that they have access to that?
That's
class?
lifetime. That's lifetime.
Okay.
It's just like
That's
the 4 pillars.
Thought. So
yeah, it's
lifetime
just like the
membership.
4 pillars.
So some people were saying, well, I need to gradually work to that. Still be a great idea to sign up for it to get the discount, even though that it's a progression, because you have lifetime access. So perfect. Yeah,
what it starts out as, if you guys are curious, I can give you. You guys want a quick tour? I can give you a quick tour if you want. Okay, all right, that's cool. Little quick tour. So this is like the 4 pillars. You can take it at your own speed. It's recorded like the 4 pillars is, so you can take it anytime you want. And I would say that if you go like most people, this will keep you busy for about a year, because we have about 50 lessons, right? About 50 lessons. And let me just get in here and I'll give you a little tour. Hang on. Let me see if I'm logged in. Okay, so here's how this works. So you come in here to Ultimate Options, you click on that, and gives you the course content. Now the first thing that happens is an options review. So let's open that in its own tab. And so each of these 8 sections have several modules to them, okay? So we give you a course introduction. We tell you how these options came to history. We review calls and puts, option premium, strike prices, and expiration. And then Corey gives you some quizzes to make sure you got your 4 pillars down, to make sure you're good with all that. So this is very much an options review. Most of this will be a review of what happened in the 4 pillars, just to make sure you got it down. Okay, then we go through what are called the Greeks. And the Greeks are these 4. Delta, Vega, and Theta are the most important ones. And then we combine Gamma and Rho. And then there's a little quiz on the Greeks. So all this little stuff you see here with this Delta, Gamma, Theta, and Vega, that's pretty important stuff to know, especially with a risk graph. If you start getting, more complex stuff with a risk graph, you want to be able to understand delta here, theta, and vega in the context of the risk graph as well. So we do the Greeks, and then we start talking about your toolbox, and we go through what an option chain is in detail. So this big thing here, this option chain, we've got to learn a lot of different stuff about the option chain. So we diagnose that. We go through the basics risk graphs, how to enter these orders, a lot of different, the trading journal, all the stuff that goes on here. And after you get there, now there's a lot of prep. Now you get to start into these basic options positions. We start with protective puts, which you know how to do. right? And a covered call, which we did today. Now there's 2 other ways to do this. So we have 2 more. Caller is a defensive strategy, how to do speculative stuff, naked calls, all this cool stuff. And then quizzes. So that's a lot of strategies in this particular one. The basic options. We have strangles, short strangles and short straddles for volatility crushes. We have spread trading. So I'll show you the ones you learned here. You learned you learned how to delta hedge. We did that lesson here. And we learned the bear call spread and the bear put spread. We go a little more advanced in these. And then the other one we did here was we did an iron condor. We did an iron condor credit. Now, we didn't do the debit and all these others that are there, but they're available for you to learn. So that's awesome stuff. So it's a pretty robust class. So about 50 different modules. Takes about a year if you go 1 a week. But boy, after that year, whew, you are smoking. You are smoking. So that's it. That's the quick tour. So that's awesome. So there you go. Check it out. Okay, we will resume. When's our next class? When's our next one?
So we changed the time on our last class. So our final class is Thursday, and it's been moved to 12 o'clock p.m. Eastern time.
Okay.
So it's Thursday morning, 12 p.m. Eastern, which is 11 a.m. Central, 10 a.m. East Mountain, 9 a.m. Pacific.
Yeah.
So we'll see you then.
Now, here's the other thing. Could you please show the website and the code again? Paolo? I'm probably saying your name wrong. Paolo? Am I saying that right? Okay, so it's ultimateoptionsclass.com. Maybe I could put that in the chat. Hang on. Let me see if I can do this. I'm going to try something. Don't hold me to this.
And I should be able to as well.
I don't know if I can do it. I'm going to try. I don't know if I can do this. Let me see. Do you know how to do that, Corey?
I think so.
Hang on, I'm going to try it. Right there. Did that come in the chat box, everybody? It's not the question box, it's the chat box. I wonder if I could do it this way. Send to all. How about that? Does that work? I don't know. So that's the thing. Now, here's your choice. If you'd like, for the next session, we can do a trade, or if you'd like, we can just spend a couple hours doing Q&A. We can just take questions, boom, 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 as fast as we can answer them. So you guys get a vote. Michael says, how long is this good for? Oh, we'll leave it up for about a week. That'll let people have a chance that want to get in to do it. We want to do both, half and half. Okay, that's fair. I like that. Half and half. We'll do the class followed by Q&A. That sounds good. What do you think? Okay, we'll do a trade. Corey and I'll talk about the best one to do. I think we ought to do a cash flow trade, don't you think? Like some kind of a debit, or a credit.
We can get back to another cash flow example.
Yeah,
love it.
Maybe a butterfly or something fun like that. We'll talk about what we can do, and then we'll follow up on all our other trades, and we'll see where gold wound up, and where EOS wound up. And were there any others? What's that? You laughing?
Aulani says, "Isn't there a picture or something you're going to share from Corey?" That was the video you promised.
Man, that's right. Oh, I'm glad you reminded us of that. We got to show the game winner. I think I've got that on video. We'll show that.
I'm not sure we want to see that.
Oh, we want to see that. State championship type atmosphere. Since then, hey, what else? What other basketball they got, Corey? They got nothing else.
That's
coronavirus.
True.
There's no other basketball.
I'm the only hoops game out there for sure.
Yeah. This is a good question. Someone says, "How do you have to start with $100,000 trade?" No. Let me tell you. Let me tell you the best amount of money to start with, and we'll finish with this. The best amount of money to start with in your trading career would probably be between $100 and $200 billion. That would be ideal. If you ask me what amount of money I'd like to start with, probably between a couple of $100 billion would just make it real easy. But the truth of the matter is, Sean says, I'm a little short of that. But the truth of the matter is the best place to start is where you are, because that's where you have to start anyway. Right? And I got a great comment here by by Chin. He says, I have 100,000 to start with, and I love the paper trading. Does $5,000 work? Yes, it does. Most brokers just like 2,000 to give you a margin. Some will start with 500. But yeah, you start where you are. And if you're smart, one of the things Corey has you do in the 4 Pillars coaching, or if you're not in 4 Pillars coaching, just in the 4 Pillars, there's 3 levels of personal fundamentals. This is so critical. Is in fundamentals, you have your personal, and you have your corporate, and you have your sovereign. That's the most important one. Right now, the sovereign of the United States doesn't look too good. $1 trillion deficits, 165 trillion off balance sheet commitments. As long as my personal one looks good, that's the one that affects me. So what you do is you get those 8 numbers I talked to you about: income, expense, asset, income, expense, asset, liability, right? Cash flow, net worth, credit score, and buying power. And you work on that Entrepreneur 8. You work on those numbers and you say, okay, here's where I start. I got $5,000 to start with. What are my goals? What am I going to do from here? Do I want income? Do I want growth? What number do I want to begin impacting? And that's where you start your journey, is right where you are. So if you got 5,000 to start with, well, guess what? That's the best place to start for you, is because that's where you have to start anyway. But yeah, the answer is yeah, you can start whenever you want. If I have 0, I start paper trading, because you'll be surprised. How many have noticed this? Once you learn how to do this, how many think it's going to be tougher to buy doodads because now you have something to do with your money? Think about that for a minute. Let's say you ran into $10,000 today. Boom, $10,000. Hey, maybe you put a new deck on the back of the house, huh? Oh, or maybe I buy some stock and write some covered calls. So what will happen is the more financial education you get, right? And that's where Ultimate Options helps, because, these have been pretty conservative trades. You learn how to do things more aggressively. People say, well, I want a higher return. I want to take more risk. What Corey would say is, okay, if you want to take more risk, better learn how to manage it then. Better learn how to manage it. If you want to go faster, got to manage that risk then. So you'll find that the more you learn about this, the tougher it is to go buy that new car, or go buy that new deck, or go buy that, because all of a sudden you're like, man, I can do this. I can have my money work for me rather than spending it. I can have my money work for me rather than spending it. Look at some of you guys are already rolling there. Okay, so this is perfect. It's Dana. Now I have a friend whose name is Dana Meyer. And so now I got it. So Dana is solid. So Dana says, hey, I'm a dude. So that's perfect. Dana. So now it's definitely Dana. Awesome. Okay. Perfect.
Such a great group.
Yeah, it is a great group. So someone had one more question about this. Did I have to show up for live class on this? No, these are all recorded with Corey and I. It took us over a year to do them, didn't it, Corey?
Yeah.
It took us over a year to build this.
It took us longer to build them than it'll take you to get through them, most likely.
Yeah,
but
that's true.
We really wanted to be very specific with each strategy and just give you exactly what we envision. So some of those classes are longer, and it might take you a couple of days to get through them and so on. And we want it to be like that. We want them to be thorough. We want them to be well explained and all of that. So
one of the things,
stuff.
And people are saying, well, we have coaching with 4 Pillars. You have coaching with this. Well, we haven't yet. We've thought about it, but we'll see. We'll see. Okay. Thank you guys. Awesome stuff. Dana the Dude, as he came to be known. That's awesome. Sean is a stud. Okay. That's correct, Rally. You got it. Perfect. Okay, guys, we'll see you in 2 days. We'll see you on Thursday.
That's right.
You're welcome.
Remember, Thursday morning here in the U.S. Thanks, everyone.
All right.
Goodbye.
Bye.